Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Wednesday, July 27th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL007, and we are going to take a look at this exciting week that we're in the middle of. And by the time you watch this, the exciting week will be over, and you'll be able to see whether or not we are off our rockers during this episode or not, because it will all be behind us. But before we hop to this week's content, I want to give a shout out to our Discord, link in the description below. It is a free area that you can hop in, join, say hello to myself, Viper, some of the other Blockhead traders. Love to hear from you, love to hear what you're trading, love to hear what type of content you'd like to see. You can also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. But Viper, let's hop to this week's content about just taking a look this week in the market. And there are some seriously big events going on this week, and I just want to kind of recap. Some of them already happened, some of them are about to happen, but like I mentioned in the intro, all of it will have happened by the time our viewers view this. So this week marks the largest earnings week of the quarter. Lots and lots of major retailers reporting this week. Walmart reporting, a lot of big tech companies reporting, Google, Apple, Microsoft. And in addition to a very heavy earnings week, we had the FMOC meeting. That's where the Federal Reserve kind of meets to determine interest rates. That actually was today. And tomorrow, we actually have the first read on the Q2 GDP. So you've heard us talk about that in the past as far as are we going to be in a recession? Where is the GDP going to be at? 2 successive quarters of contraction designate a recession. And tomorrow is the initial read of Q2 GDP. The actual official final number doesn't come out till the end of August. And so you'll see it reported then as the revised number, where they basically go back through and double check everything. But tomorrow will be the first read of that. And so just so much uneasiness in the market this week. We started off the week kind of on a down note because Walmart really missed their earnings, and they guided lower. And this was kind of a big deal because Walmart is really kind of considered almost the canary in the coal mine when it comes to the health of the consumer. And we all know inflation is out there. Inflation is very high. I think we're now at 42 or 43 year high. I feel like every time it ticks up a little bit, they just kind of clock back a few months from 1980 when inflation was this high before. And anyway, a lot of people are keeping the eye on the consumer because as inflation grows, the consumer their spending power is less. They spend the same amount of dollars, but they get less goods. And so that can cause them to start contracting their spending on discretionary items, things like that. And I think the market is waiting for that because that's the type of stuff that is propping up earnings, expectations, and all those things. And so right now, this wonderful house of cards is kind of resting on what is the consumer doing. And when Walmart came out and said, yeah, things are not so great, we're starting to see a big hit in clothing, home furnishings, things like that. They said everybody's still buying food and groceries and things like that at a similar pace. That's indicative of potentially people starting to watch their pocketbook and, not buying that new outfit for school, not splurging on that, but basically kind of pulling back on some of the other things and focusing more on the staples. And so that got a lot of the market in a tizzy because they also guided lower for the balance of the year. So Walmart and a few other retailers, those were earlier this week. There was a little bit of a foreshadowing at the end of last week when Snap reported their earnings and just dramatic cuts. They did not even come close to expectations, earnings expectations. They dropped like 40%, I think, on Friday. And so that was a sign. A lot of people took that as a sign that advertisers are really pulling back. They're really focusing their effort, their dollars on the platforms that are really going to reach the most people, and just everybody kind of starting to watch their pocketbooks more. A little bit later on Tuesday, I think some of it might have been after the bell Tuesday, we got a couple of hits from Google, I think, reported, and Microsoft reported some tech bellwethers. Apple is actually tomorrow, and the tech bellwethers fared pretty decent. The earnings were relatively positive, kind of showing that the tech companies had kind of prepared for this. Yes, they guided lower. Everybody was kind of expecting lower guidance, but they weren't expecting them to maybe meet and exceed some of the earnings expectation and revenue expectations. So this was a lot of the jitters that came out before today, and still the market was really on edge because they wanted to see what's the Fed going to do to fight inflation. And that was the action that happened today. Chairman Powell came out from the committee, and they basically announced that they were going to raise interest rates by another 75 basis points. 75 basis points is 0.75%. And that was the hike that they did last month. Those are very, very aggressive numbers when it comes to hiking interest rates. They are seldom seen. I think the last time that we saw a 75-point basis hike was back in 1994. I can't remember if we had back-to-back 75 points or when the last time that might have happened, but this is basically 1.5% that they've raised interest rates in the past 60 days, and that's huge. I guess you could say in the past like 30 days because it was basically the June meeting, so like the third week in June, and then now third week in July. And the market was happy about that. They went off to the races. I think the S&P was probably up, I don't know, maybe 1.25 before the Fed announcement. The Fed hit their announcements, and we were off to the races. Just monster candle on the S&P. I think we ended up finishing up 2.5%. We'll take a look at some of the price action here. I think Viper's been tracking this. He's got some theories we'll kind of go over. I did not really fully digest everything, but I've been kind of the opinion that we're starting to form a bottom here. I don't personally think we're headed for a V. Like, I don't think this is going to be like the COVID crash where we come down and then we're just new highs. Maybe, but I think it's more likely we're going to start to settle in to more of a channel sideways action, maybe slowly creep up. We'll really see what happens when the GDP comes out tomorrow, how much influence that has. It's a backward-looking statistic, and so I don't know that it's very indicative forward-looking. The key part about it is I think it'll play in people's psyche a lot. Are we actually already in a recession, or is the recession ways away? And I think it's going to be more of a mental game when it comes to traders and things like that. And so I think we have a high potential for an emotional reaction to whatever number comes out tomorrow. So Viper, that's kind of my recap on this particular week. I'm really looking forward to Apple's earnings tomorrow. But we're going to save that for a future episode. So, what's your take here on these crazy markets lately?
Yeah, so I've been noticing, there's a few things that have been happening in my brain, in my learning experience, in my journey through this, and some of it's unfolded in our Discord and just in interactions that I've had in there with other members, with our master charter in chief, or whatever we want to call him, but just kind of the guy that I've been learning a lot of my foundational technical analysis from, and so I'm kind of want to put a lot of that together because it's created this pattern that I've noticed, which is we have these events like today, the FOMC meeting, the rate hike And everybody builds into a frenzy and a panic leading up to this thing. We all speculate, we all wax poetic. We've done it on this show of everything's priced in, it's fine, or all this kind of stuff. And one thing that always seems to happen is there's tons of speculation of like, oh, this is going to be terrible, like it's going to be bad news, and then blip. They predict it'll be bad news or good news, and then we're going to pump, or then it's just going to dump down and do nothing into nothingness. And so what I've started to pay attention to and notice is it's interesting to follow the price action following these binary news events, and what we get out of it. And so what I want to lay out, if we jump over to a chart here, is let's get some whiteboard space here first. So my theory, and this is certainly not proven or even studied, so if anybody has more education behind this, certainly very curious to that. But my theory is, we all know that a chart doesn't just do big clear up, clear down, clear up on a big time frame. That it's just not clear like that. And what we end up getting is we always do these little wavy waves, and we set lower lows or higher highs and all that kind of stuff, and the journey is kind of messy looking. And but through this, we can obviously gain that, okay, this is an uptrend. And then there are clear markers in technical analysis that indicate when that can be considered a reversal. We're not going to get into all that. But my point here is just saying we all know that there's all kinds of these weird, not weird, but just sporadic movements during an uptrend. And so, obviously we can see that. I'm currently looking at the Ethereum chart here, and mostly for purposes of what I'm getting at, it's just easier to look at a crypto chart because it's more fluid because of its 24/7 trading status. But so we can kind of, we clearly see this. We get this up and down and yada yada yada. So what I'm noticing and theorizing is that during a trend, movement is not fixed per se, but the trend is fixed, and movement within that trend is going to follow very strictly technical analysis rules, price action rules and levels and stuff that we get into all the time in Discord. The thing that binary events change is not causing a reversal or causing a big dump. That what binary events change is they change the speed and the acceleration in which the current movement proceeds. And so what I thought was interesting, I didn't initially plan to even look at this, but kind of looking at this big picture on Ethereum, I thought this was a cool opportunity on this chart. If I just do some real fast TA on this chart, like obviously, okay, so we came down here and we're bumping up here. I can explain these things. We can go deeper into this in another episode, but kind of some levels I immediately call out. Let me just do a horizontal line is first of all, okay, we broke down here, and when we did that, we lost this critical level here. Let me make that a little thinner. So, okay, that's important. And what else? So as we fell, if we go back in time here, a couple other things. Okay, this was a previous all-time high. Let's grab that. That failed, and let's grab this guy here. And so these, you can see I'm looking backwards to find these levels. And now looking forward a little bit, all of a sudden these levels are holding. Like, this one held, we retraced back, we bounced off of it. And even on this particular massive crash, which everybody's seen the news and knows very well, we didn't land at a weird, unexpected place. We kind of landed, and let me also back up. I'm not calling a bottom. Bottom is zero. Zero is the only bottom we care about. We are calling trend patterns and probabilities. Nonetheless, when we were all the way up here, if you got on Twitter and told anybody that Ethereum was going to be around $900, like you would have been perma-banned from Twitter. There was no way it's not happening. But just these charts, or just these levels that I drew up real quick, 820 is a very realistic pullback if you lose the all-time high swing, which obviously we did. However, we're not going to necessarily go straight there. The first thing we would fully expect is, where does the swing start that starts the all-time high? If we lose the uptrend and we get into a reversal, absolutely probability is we're going to go test the bottom that launched the swing. So we did, and obviously that happened here. And then we couldn't hold that, and we lost, and then we eventually found our way back down here. But tying this into what I want to talk about with FOMC and whatnot was, if you notice, something happens here on the chart. Okay, so we established down. We established that, okay, it was no surprise. This happened November into December into January, so we can all play back in our minds what was happening around that time. Things weren't terrible, but weakenings was showing, but nothing was super dramatic. But it was clear we were doing a little bit of a pullback. And now if we just follow the chart action, we get a pullback, but we get a nice bounce, and then a pullback and a nice bounce, and we're just kind of on this pattern. We'll call it healthy, a healthy rate. I mean, this starts back in October, November of 2021, and we're just kind of lazily going through this downtrend till April, and then all of a sudden we hit April, and now what happens? We are massively accelerated, and we come down, and we go sideways, and then we massively accelerate down. And so to me, that's an acceleration, not necessarily an unprecedented dump. It was just the acceleration of it was somewhat unprecedented. And so obviously we all know what happened around then. All this inflation news starts hitting, and panic, and we're going into a recession and all this other stuff. And so we've accelerated the movement that was already expected. We've accelerated testing this. We couldn't hold this. Some of that could be market conditions of not being able to hold that level. But once we lose it, if we zoom in a little bit here, it was a very accelerated. We lost that level. We just blew straight through this level, and we landed down here where we would have expected to fall. And now you can kind of see that we're crawling our way back up, and we're kind of on a slower, we'll call it again a healthier move, where we come up, we test this level, we gain it, we come back, we retest it. And this is kind of over the span of a week or two. So that brings us to the FOMC meeting this today. And leading up to it, obviously, there was a lot of concern. There was a lot of, it's going to be a disaster. There's going to be a full point, 100 basis points rate hike. We've talked about it on this show of we kind of think it's priced in, but still, nonetheless, there's a lot of emotions in the space leading into today. So what I thought was going to be interesting is, let's really zoom in and let's look at last month's FOMC rate hike day, which is today. So we're not looking at when the meeting notes minutes come out. We're looking at the rate announcement. And how did the market react a month ago? And just again actually we're gonna take a look at crypto, but we're also gonna go to the S&P and evaluate there and kind of play out this theory that I have about the speeding up of the trend or the movement rather than causing a differential out of it. So if we go back to last month, we're looking at Bitcoin, and again, it was a 2:00 announcement. And if we look on the chart here, we are staring at the 2:00 candle, this red guy right here. So the news comes out, and it was a sizable dump of sorts, where the 15-minute candle from wick to wick, was a 5-6% move down. And so for the first 15 minutes we were down, and then all of a sudden we get this big run up after that. So that's interesting. At the time the news comes out, we get a big dump, and I'm not going to zoom in here on this chart, but if you look at the 1 minute and the 5 minute, it wasn't even over the span of 15 minutes. It was like a couple 5-minute candles one and a half that just really ripped down. Like the news came out and you just saw the chart drop. So what gives? Well, in the as far as my thesis, my theory goes, in the grand scheme of things, like we were doing, we were kind of doing this seesaw in here. We were making lower lows as we kind of dropped down. We'd try to climb up, but then we were starting to fail to make higher highs. So we're in a downtrend, and we come off of this guy. We try again and we fail to make a higher high. And so now we're again going to go down and possibly make a lower low, but the expectation is to at least test this previous low here. And so when the news comes out, we're in the middle of that move. When the announcement happens, we are potentially trying to test this low, but regardless of whether or not we get there, the real point is that we are on a drawback and we're finding a local bottom. We're finding a local low. Maybe it's a test of this one, maybe it's a higher one, but you can see that we're coming down here, and then we actually start to bounce up, but we're still in this downtrend, and so then we accelerate down. We get to this bottom, which the wick is, it's right there. Let me get that out of the way. Just watching the cursor, the wick of that candle is, it's right about to that bottom where you would expect we would be testing to either test and get support or form a lower low and come down even further and continue the downtrend. So we've come down now and we've tested the previous bottom, and we actually bounce support off of that. And so then we start our climb up, and it's a pretty fast climb up too on the news. So in this case, we actually got this interesting look of an accelerated down, and then we start going back up. So let's take that, keep that in mind as we go forward now to today's price action on FOMC. So here's today's price action, what we saw today when the news came out. So I have to admit, going into this, I was not thinking super clearly. I was not fully playing through my theory here, and so going into the meeting today, I was like, you know what? Last time the news came out, and I was allowing some of those market emotions to come into my thinking process. I was like, last time people wanted it to be bad news. And I just classified it like an institutional dump, and then either a consumer dump or an institutional dump. That was the spike down, and then we recovered. So going into today, I was like, you know what? I'm going to be smart. I'm going to beat the market. And I was like, last time we had this dump and then we ripped. And so I was like, yeah, that's just going to happen again. This should be ringing all sorts of alarms. You don't do this. The market history never repeats itself, but it definitely rhymes. So I was like, it's just going to drop, and I'm just going to scalp a short real quick, and then I'm going to close it, and then it's all going to be good. So what ended up happening, though, now if we look at Bitcoin, it's pretty clear here. Right at 2 o'clock, we are looking at right here. We're still looking at the 15-minute candle. 2 o'clock on the dot is the bottom of this candle. So you remember last time it was a red candle. It had a big wick on the top, a big wick on the bottom. In this case, today, we had 0 wick on the bottom, which means 2 o'clock started and we were gone forever. For the rest of that 15 minutes, it was up only, at least from where that candle started. So not good news for my little cheeky shorting adventure. And as you can see here, we just soared, 7% over the span of, this was like half an hour, 45 minutes, something like that. Just gone. So what the heck happened? I thought that, there was an emotional dump and then reality sets in and people like it, but there was just nothing. This was just all up. Well, going back to my theory, I'm going to save you some time, and I plotted out some levels at the same exact way I just plotted out on Ethereum there. And what we see here is, first of all, the theory, from this bottom here, we start making higher lows. So we are officially in an uptrend. This was on July 26th, so we're on the 15-minute candle, but we're kind of doing, just our, lazy Sunday driving. We're going up and we're just swooping around. However, before we get to the spike here, we're in an uptrend. So what's an uptrend going to mean? Well, an uptrend means that we're going to at least want to have, or we're at least going to have the probability to test the previous failure. So the previous failure swing is right here. So let's just drop a quick line here. This isn't super accurate, but somewhere around there, we're going to have a test on that. And if we go ahead and gain that and then get support off of that, well, then the pattern is to go and test the next failure. And we can see that the next failed level is up here. So what happens if we zoom in? Sure enough, we're obviously going along about our way. We gain that level we just drew. We gain it. We test it. Okay, so we tested it. We cleared it. Now we've officially confirmed support. And this is all before the binary news catalyst. So we're kind of in like the best case scenario for a long run here, which, remember when I said I was going to outsmart the market? We're in best case scenario where we've gained a level, we've confirmed support on it, and we have a catalyst moment. In this so what I'm getting at is the catalyst did not cause us to go up. We were going up already. However, we greatly accelerated that time frame. So what I believe is, had this not been the news day that it was, that we would just, maybe on this time frame, we would just continue our pattern and we would still arrive at the destination. However, we catalyst, bolted up, arrived, and now we're doing the things that you would expect at this level. We gained it, we're testing it, and so far we're holding it. So one last chart. Now let's hop over to equities, and we're going to look at the same idea. So I'm going to spare a lot of the charting, and basically on the daily for the S&P, we can see that we're in an uptrend, and in this uptrend, you want to continue for continuation of the uptrend. You want to gain something you've lost. So ultimately, what we really want on the S&P here is we want to get up here and we want to gain this stuff up here in the 4100s that we lost, but we're not there yet, and baby steps. So part of those baby steps are, well, there was the move that started this. You can kind of see forming a little bit around here. I went ahead and zoomed in and said, all right, well, if we're going to go on the uptrend, we need to hold this high, this local high that we made. You can see we tried and failed and we were back down, but now we gained it. So once we gain it, we need to hold it. How do you hold it? Come back and test it and get your support off of it. So yesterday we came back and tested it. Today we opened. So if we jump now to the 15-minute chart and just come in a little bit, you can see we came down, we did our test, and then we gapped overnight. We gapped up, confirming support of this level. And now we're in, if this sounds familiar, this slow, healthy uptrend until spot the news. We have our FOMC rate announcement, and it's a catalyst. It's accelerating the current activity, the current trend. And so there we see it again. So that's the gist of it. Like I said, I'm playing through. I'm continuing to evaluate. This is hardly a firm, like, this is the thing, just, but at the same time, what would the announcement today, like, we're in this uptrend. We've confirmed support. What could an announcement have been today that would have all of a sudden reverted the current trend? Like, clearly, bam, rejection, and that rejection happening right here where there's not even really anything technically to reject off of. And I think that might be part of the puzzle, just thinking out loud of, these things happen, these trends and the movements happen because there is a history of support or resistance at that level. When we're in the middle, there's just not much resistance happening. So it's just kind of a boat moving with the tide, and then you just get a big boost of accelerant to continue whatever direction you're going. At least for now, that's the theory. And I mean, just like a trend reversal, it's continuation until proven otherwise. So that's how I'm gonna treat this theory, that it's an active working theory until proven otherwise. And I would love to hear any examples or theories as to what could prove it otherwise. But in a nutshell, that's what I think. How's that sound to you? Can I get my first skepticism or confirmation here?
Yeah, I think with most things that we see, there's nothing ever definitive. Nothing is ever a hard and fast rule. It's all, guidelines of, oh yeah, this usually happens and things like that. And so I think your theory is pretty good, pretty spot on. I would say that I kind of also subscribe to a similar theory that your binary events are really just accelerators. They're events that release momentum that's already waiting to come out. And that's one of the beautiful things about premium selling is when all of that is pent up, your volatility and your unknown is quite high. And so the premium is high. And so I actually do a similar thing to you, although I wouldn't consciously do it. I don't think I consciously do it. But when I play earnings, a lot of times I'll only play earnings in equities that are already kind of in somewhat of an uptrend. I always try to look for somewhat of an uptrend, but kind of early on in that uptrend. So, maybe it's been going up for months and months and months and it's at all-time highs. That's typically not in earnings that I play. One of the things I like to play is, earnings, while a company might be on an uptrend, it's more early in that uptrend. And the reason for that is a lot of times you never know how earnings are gonna pan out. And I love to sell puts. And in order to sell a put without protection, you have to be okay owning the stock. And I'm never really that comfortable getting into a stock by an all-time high. I know a lot of people will tell you, well, if the stock's awesome, it shouldn't matter if it's at an all-time high or not. I'm like, I just don't do that kind of fundamental analysis. I look at probabilities, I look at opportunity chances, things like that. And to me, there are more opportunities for growth when you're not already at your all-time high. And so I think your theory is a fine theory, and it probably holds most of the time. I don't think it's all of the time, but I would subscribe to the fact that it is a majority or majority of the time, which goes right to that probability way that you and I like to kind of trade is how much of this can we tip a little bit more in our favor and just go with that.
Yeah, absolutely. And that's a very important point to call out, is the probability, and really driving home the fact that the whole thesis to our entire story of every episode on this channel is develop a system, build that system to get you 51% of the time, winning, and give you a majority probability for a win. More than that, great, but build a system that can do that, then stick to your system, and then you start to be able to rely on the odds of probability to hold you into that profit. And so this absolutely, goes right along lines with that of, there's probably cases where this is just busted and shattered. But if we look at there's at least 51% of the cases where this absolutely holds up, then that's worth being part of that system if it fits, and building that repertoire that gives you that majority momentum.
The big focus, like you said, is put the probability of winning in your favor as much as you can. I prefer much more in the 75%, 80%.
Right.
But the other key point is you have to have an exit plan, and you can't let your losses get too big, because if your losses get too big, they will swallow up every edge of probability gain that you have in the other direction. And so I often equate the stuff that I do to hitting singles. It's boring and things like that, but you can hit a bunch of singles, But if you give up a grand slam against the other team, that's going to hurt. Yeah. And so it's all about controlling your losses. And I really think that is your differentiation between other traders is control your losses, because put the odds in your favor, control your losses, and you're going to do better than the majority of people out there. And that goes back to have a plan, stick to the plan. Your plan has to be when things work out the way you want, and what's the plan when things don't work out. And have that ahead of time to keep the emotions out of it. Otherwise, you're going to be tempted to do something dumb.
Absolutely.
So that brings us to the end of this week's episode. This is just an awesome week to sit back, watch the price action, watch what happens. You don't have to be trading it. Remember, even trading nothing and sitting on the sidelines is a valid option. Holding cash is a valid option. Don't feel like you always have to be in the market all the time. Yes, there are opportunities here, but there are opportunities for gains and opportunities for losses. And so if you're not real comfortable or you're thinking about some of the stuff, get in there, watch the price action happen as the candles form, go back at the end of the day, watch how they trended, overlay it with when news came out, pick a couple of earnings, see how they react. Just all these events, the best way that you can become more comfortable with them and more accustomed to their behaviors, their things that they do, and just observances is to simply observe. That's the best way. So hopefully everything panned out okay for you guys, and you have a great week coming up. So good luck out there. And remember, think outside the block.